All right, all right. It is IUL Wednesday. And if you guys don't know me, my name is Moses Nelson. I am a financial strategist. I am a tax minimalization specialist. And I am the author of Tax Free Freedom. And I'm going to walk through my deck this week and hopefully answer a lot of questions. But if you have questions, feel free to drop them in the chat. Answer them as soon as possible, or you can just simply DM me, or you can reach out to me via email, which is info at seedandshieldfinancial.com. But all that information will be in the description. So let's go ahead and get started. All right. So when it comes to the three biggest dangers in retirement, those three dangers are: number one, rising taxes. I think we can all agree to that, right? And I'll talk more in depth later in the presentation. Inflation, again, we felt it like crazy um, during the pandemic, but inflation has always been around, right? It's a healthy inflation is 2%. It's just that we felt it this time because it was, you know, monumental changes in our spending. So inflation is a real thing, and it could be uncontrollable at times, and we want to be prepared for that. And market volatility. Okay. So when you look at these three things, when you're in retirement, again, you've worked 40 years, maybe even 50 years. And now you just want to be able to sit on your money and be able to live out your days comfortably. And when you look at these three things, the normal person has no control. They don't control the tax rate, they can't control inflation, and they can't control the stock market. So this is why so many people are uneasy about retiring, especially those that are in retirement. See, the people that are my age or younger, that are really not financially focused, they are like they're so far removed from it. They can't grasp the understanding of it. But if you are 65 plus, or you're even like 50, late 50s going into your 60s, and you're starting to feel it, you know what I'm saying right now. Those three things are real. So we're going to talk about that. So breaking down danger number one a little bit more, right? So when you're in retirement, you're handing over your financial future to the government, because most people, when they prepare for retirement, they're using IRAs and 401ks, which are retirement accounts that are tax deferred. Okay. So who controls the split of your ownership? And what I mean by split is taxes. Taxes is a split. They're essentially saying you didn't have to pay me on the money when you're contributing, but at some point, Mr. and Mrs., you guys don't have to pay me back. They control that, right? But you can take control back. Okay. Let's talk about what future tax rates would likely be. Okay. So this is a question. Do you think it's going to be lower, the same, or higher? Gave you the answer because, again, 99 out of 100 people, when I ask that question, they all say higher. So if you know that you will be in a position to pay higher taxes in the future on your money, why would you wait? That is a question you need to ask yourself. All right. And there's multiple ways that the government raises taxes. Don't be fooled by the first one and think that's the only way. The most obvious way is simply raising the tax rate across the board, right? You go from 35 to 38, okay, it's a tax increase. But they can actually manipulate the tax thresholds. Think about this. Have you ever start making more money and you thinking, wow, something doesn't feel right. I'm being taxed more. Okay, that's because sometimes they widen the tax brackets. So they'll put more people in a higher tax bracket where the tax rate had already been defined. So let's just say, if you made $100,000, you are supposed to be in the 30% tax bracket. Okay. Everybody says, okay, that's cool. But what they can do is they can say, all right, we're going to, instead of it starting at 100,000, we're going to have it start at 90,000. So if you were making 92,000 and you were paying 25%, now you're paying 30%. You see how they didn't increase the tax rate, they just simply widened the tax brackets. So that happens a lot. And then the third one is that they eliminate deductions flat out. So I'll talk a little bit more about that in later in the presentation, but that's a huge one. Okay. So if you had any reservations as to your taxes being higher or lower in the future, I just want you to take a look at this chart. So the far left of the chart, when income taxes were implemented in 1913, it started out at a 7% tax rate, meaning this is the highest taxes someone could pay, 7%. But as you work your way up a little bit here, you see we're going to go up, then we went down, but we never seen that 7% again, right? But it went as high as 94% at one point, okay? 94%. So now, we're kind of stair stepping ourselves down, but we're at 37%. Okay. So again, for the people who feel like they're overtaxed, when you look at this historical range of tax rates over the last 100 years, 100 plus years, you can actually see 37% compared to 94%. You'll take 37 all day, right? Exactly. So if we're trending on the lower end of taxes right now, knowing what we know about what we have going on in the government, why would you think that taxes would be lower? Okay. So just think about that. Don't take my word for it. Use your own knowledge. Okay. So this is just simply saying, hey, in 1917, the equivalent of a $500,000 today was $20,000. And that person would have had a 12% tax rate. You fast forward to 2025, that person would have a 37% tax rate. So you see, equal dollars as far as spending power, yet the tax rate is tripled. You see what I'm saying? Like what could prevent that from happening again? You got to think about that. Then tackling those deductions that we talked about. So when you're in retirement, you typically lose these three deductions. Most people have aspirations to pay off their home. So once they pay off their home, yeah, you don't have a mortgage anymore, but you now lose the mortgage interest tax deduction. There's a high chance that you don't have any children that you can actually claim on your tax return, so you lose those deductions. And then the obvious one, if you were putting money to the side for retirement, now that money is not, those contributions is not helping you on the tax front anymore. So you're losing your three largest deductions when you're going into retirement. So when people tell you your taxes won't go up, I want you to refer to this slide because it's a good chance it can. It definitely can. Danger number two, inflation. Inflation in the sequence of returns, and just pretty much to sum it up, running out of money during retirement, which is a huge fear. People are living longer. Okay. When the retirement age of 65 was put in place, I hate to say it, it was thought that, this person had a little bit of time left. It wasn't that much time left to go. That is so not true today. And think about how powerful, how untrue that would actually be in the future, where more and more people are living to 100 and high. So the risk of losing and running out of money is so serious, and we need to get in front of it. Okay. So I want you to remember why we are actually doing this for retirement. Why am I saving my money? And why do I need my money to grow? It's because of inflation, right? Because your spending power today will not be the same 20 years from now and so forth. Okay. You have to focus on the stages of money. So you have the contribution stage. So that's when you're actually working. That's when you're putting money into an account. You have the accumulation stage where the money is compounding, whether or not you're contributing or not. But the thing that makes a difference, the thing that's going to make your retirement click is the distribution of money, right? You want to be able to tap into that money and never fear that it's going to run out. And that's key, right? So the general consensus of a lot of financial planners, and I'm not a financial planner, I don't want to be because I have, different thoughts about it. I'm a financial strategist where I focus on helping you make the best decisions and get out of the market. So that's key. They're going to always tell you the 4% rule. And that 4% rule is simply for them to be able to comfortably say, all right, Mr. Client, take 4% out in hopes that we can get a 6, 7% return. That's pretty much where that's coming from. The problem is with market shifts and adjustments, that's not going to always work. And people are running out of money, right? So you have to actually shift your thought process on how high my balance is and really focus on what actually I can pull out every single year. And when you look at it, the 4% rule is not really 4%. After taxes is more like a 2.64% rule. So that's key. So again, what I just mentioned, what instrument could help me generate the most amount of income, like true income, money I'm putting in my pocket, and that's where you can actually feel comfortable starting to take out 6 to 10% of that money tax free every year. That's really what you want to be focused on, not a 4% rule where you then have to, take taxes out of it. That just doesn't even make sense. So let's take a quick pause and let me just ask you this question. If you were a farmer and you had the choice to pay taxes on the seed or the harvest, which one would you prefer? I'll repeat. If you were a farmer and someone says, hey, 1, 2, 3 farms, you can give me a percentage of these seeds, or you can give me a percentage of the harvest that you're going to have later on. I think again, 99% of you guys would say, absolutely, let's go ahead and pay taxes on the seed. But when you actually have a 401k, an IRA, or any tax deferred retirement account, you are paying taxes on the harvest. You got to stop doing that, y'all. Danger number three, the best thing to eliminate from your financial strategy is to get ahead. And that's by eliminating losses. If you never lose, you'll always win. Okay. And the way you can do that, I'm going to show you shortly. But before we do that, I'm going to give you the two rules of investing from Warren Buffett. And it's kind of funny. So the first rule is to not lose money. And the second rule is to not forget rule number one. All right. So let's talk about not losing, right? But before I want to level set because a lot of people really do not understand this. If your money was in the stock market and it went up 50%, then went down 50%, then went up 50%, then went down 50%, what is your rate of return? Okay. If you're watching this, probably most of you would probably say zero. And don't feel bad because that was me at one point. But you would be wrong. Okay. So this is your rationale. Plus 50, minus 50, plus 50, minus 50. But it's actually not true. And again, don't take my word, do the math. All right. So if you started with 100,000, up 50% would have got you to 150, down 50% would have got you to 75. This is where the light bulb comes on because most people would have thought up 50 and you go right back to your 100,000. No, 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 no. It is down 50% on the new balance, which is 150,000. So then to be able to make yourself get back to anywhere close to 150, it's not going to happen if you go up 50%. You know why? It's going to go up 50% from 75. not up 50% off of 100. So as you can see here, someone thinking that they would have a 0% return or they'd be flat would be dead wrong. You would actually have a real return of negative 43.75%. So here's a snapshot. A 25% loss would need a 33% gain to get back to zero. A 33% loss would need a 50% gain to get back to level. And a 50% gain would need 100%, well, a 50% loss, excuse me, would need 100% gain. So when people tell you just stay in the market, it'll always recover. I need you to refer to these slides. I need you to do your own math. I need you to understand that that's not true. Okay? This right here is a snapshot of the S&P 500, which is the most popular index on the market. It is a collection of the top 500 stocks in the country, in the world, right? If your money was in the stock market from January 2000 to March 2020, roughly a 20-year span, this is what it would look like. You would have gone up in 2000, 8.97%, yet you would have had a rough time, a real rough time the 3 years after. You would have lost 2%, you would have lost 17%, you would have lost 24%. But remember, I just told you. So you're far ahead of these other folks, right? So you see all these drops, these losses, they're going to say, well, look, it bounced back. It went up 32%, but you're not nowhere near close to where you were. Okay. So just understand that it would take time to get you back to level. So you see, not only that, just look at the roller coaster that you're going through, up, down, up, down, up, down, up, down, right? So the average return over 20 years was 5.6%. But the actual return, when you factor in the the losses, was 3.14%. And again, these are going to be the same people telling you just let your money ride, just let keep your money in the market. Okay, they keep you naked in the market. So 5.6% was the average rate of return. The actual return was 3.14, but after taxes, it was 2.2%. Okay. So when people tell you this, and this is a 20-year period, this is not me cherry picking 20 years or whatever. This is a very relatable 20-year period that just happened. Okay. But it's a different way. It's a better way. If you would have had your money in a max funded index universal life, an IUL, you would have avoided every single loss. Because the way the IULs work is that you are guaranteed to be at zero. If the market ever drops below zero, it doesn't matter. You're guaranteed. You're never going backwards, right? And what happens is when the market, you have a cap rate. So in this illustration right here, your cap rate is 11%. So that would be the max you can get. However, at the time of this video, it's 2025 right now, the cap rates that I set my clients up with is 12%. It's available right now. Okay. But 11% cap rate, look at the difference at this 20-year period that this client would have experienced if their money was in there from January 2000 to March 2020. They would have still experienced that year one 8.97%. But when those three back-to-back years of losses, it would have been zero, zero. Then they would have got 11% of the upside when it went up to like 30 something, right? But they weren't never in a position of going backwards though. And both would have shared 4.43, 8.36, and then they would have capped out at 11, right? Then it was back down to 2008 and 2009, where it was crazy losses. You would have been at zero loss, not $0, meaning zero gain. You never go backwards. Okay. This should bring it home for you This is the actual numbers. This is the actual dollar amount. So we're using $330,000 as an example. If someone had a $330,000 401k, they had in the 401k at that time 330,000 versus someone having 330,000 in an IUL. You can see here that a 401k would have been going up and down, 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 and would have leveled out at 844,000. Did it grow? Absolutely, it grew. Bravo. But that same 330,000 would have been $1.3 million. On top of that, on top of that, this right here would have been tax free. Tax free. This right here would be subject to tax. There's three strengths to indexing, and that's what that strategy is with that IUL. That's why it's called an index universal life. So it's a universal life insurance policy, but index meaning that you can actually participate with market returns, but not actually have your money in the market. Now, that's like a cheat code to be able to participate in the market, but not actually have your money subject to it. That's like going to a casino and they saying, "Hey, yeah, we giving out $1 million, jackpots, but you can come in here and not lose a dime in of your money. And if you hit the jackpot, we'll give you a $500,000." That's what an IUL is to me. Yeah, did I leave with the million? No, but I was guaranteed to go into the casino and not lose a dime, and I can come out with 500,000 with no risk every time. Every time. It's just crazy to me, right? So the first one is you don't lose money when the market goes down. Your it's called point to point. So every year you can refresh what indexes you want to go into. I pretty much commonly use S&P 500, but there's other indexes out there, and it's locked in. And you can reset and change the indexes every year. So if you feel comfortable saying, "Hey, you know what? S&P is not for me. I want to do a different one," you can, you know? But the main benefit is that you don't lose a dime, okay? The reason why this works is not because Moses said so, okay? It works because this is an IRS tax code compliant process. And it's three laws. Okay. 101A means that the death benefit is a tax free benefit because the government does not want to be responsible for taking care of widows and widowers and orphan children and things of that nature. So, what they do is to ensure that your beneficiaries are able to take care of themselves and remain whole if you're not around, the government says, "Hey, you know what? Anything that's in a life insurance policy, as long as it's compliant, it's tax free. It's a benefit to the government because they don't have to worry about you." Okay. Then 72E is a code that enables for tax free growth. Okay. And then 7702 is where you actually can access the money within your insurance policy via policy loans. And that is tax free. It's amazing. Okay. So I am a rental property investor. Some of you might know me as Moses the Mentor. So this is how I'm gonna help bring this home as an analogy right here, right? So imagine an IUL is a 5-story or 5-apartment building, right? When I say max funded, look at that as a maximum occupied building, right? So if you have 5 apartments and you have 5 tenants, you're making money, right? But if you have 5 apartments and 3 tenants, every month you're losing 40%. So the way you structure an IUL, the way you fund an IUL is what the secret sauce is. Anybody can get an IUL. Anybody can sell you an IUL, but they're not going to structure it. They're not going to help you understand how to fund it correctly like me, right? So we need to make sure that we have a conversation so I can help you understand how to do it because I'm always going to structure it right, but it's still up to the client to make sure that they fund it right. And we would just talk about that. Okay. I get pushback sometimes. Some people say, "Oh yeah, there are other investments, blah 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 blah," and I always stop them because I love this. Life insurance is not an investment, so you don't need to even try to compare it with me. The moment that the moment that something is an investment, that's the moment that the IRS says, "No, let me get my tax money." We don't want IULs to be an investment. We don't want it to be risky. We want it to be exactly what it is, an insurance policy. So for you to actually enjoy the benefits of those tax-free growth and tax-free withdrawals, all that stuff, you have to structure it within a life insurance policy for it to be compliant. The moment you go outside of that, that's a different playing field that I don't want no parts of. Because when I set someone up with an IUL, I can sleep good at night because I know they'll never lose a dime. I can sleep good at night to know that if they were to pass away, that their family is taken care of. So that's all that matters to me. I don't care about playing in the stock market. Okay. The way it works though is that when we have a conversation, we need to determine what your bucket size is. And I don't want to overcomplicate it on this call, but essentially, we need to know how much we can put in this bucket over this 5-year period, right? Because it's called a GSP, a guideline single premium. Most people is roughly 5 years, maybe a few months shorter or a few months after that. But it's let's just say for easy math, 5 years. For example, you might say, "Hey, you know what? I have an IRA with $100,000 in it, and I also have 50,000 that I think I can contribute out of my pocket over 5 years." We would design a policy that can accommodate $150,000 over 5-year period, and we want the smallest amount of actual insurance possible to help us do that, so your cash value can grow faster. So we would determine what this bucket is, right? And we would stay compliant with TEFRA, DEFRA, and TAMRA, which are the tax laws, right? For you to maintain that benefit. And then from there, once it's set up, at that point, you and I would have annual reviews, but you would pay your premiums as designed, and this bucket would fill up. So you got the new cash contributions, you have your compounding interest, and then the only thing that's coming out of your bucket is your actual charges for your insurance policy. That's it. So you paying for your insurance policy. Now, obviously, the benefit would be to your actual beneficiaries, but the focus of the bucket is what you actually use in life. So to stay compliant, you have to put it in the form of insurance. But again, you're pouring the contributions, you're pouring the compound interest in, and you just got a small little spigot of insurance, mortality, and expense charges that come out. And after 5 years, you have this fully funded IUL. At that point, you can turn everything off and just let it ride, or you can continue to contribute to it and grow even more. But most of my clients, that 5 year, they're moving money from a tax deferred account and they want to put it in there. Or it could be someone who's actively working that's saying, "Hey, you know what? Why am I paying to a 401k? Why am I putting money in a Roth? Why am I putting money in an IRA?" And they shift gears and establish an IUL even way before they're actually at retirement age. So that is the end of my presentation. And I just want to tell you guys, hey, if you have any questions, let me stop sharing. If you have any questions, just reach out. Just reach out to me. I'm going to put all my information in the actual description, or check my profile. Be happy to, talk to you. We can see how this can work for you. So thank you so much. And I'll be doing this every Wednesday. So check me out every Wednesday at 5 p.m. Eastern time. This is IUL Wednesday. Talk to you soon. Peace.